For the economy, and should the Fed still hike by 75 basis points again next week? Let's ask Ethan Harris. He's global head of economics research at Bank of America Securities. It's great to see you, Ethan. And the bond market, ironically, is now acting like inflation will prove transitory.
Yeah, I think the story is that it's going to take a very, very weak economy to cure the inflation problem. And so the Fed really has to move ahead and continue to hike rates. They're still well below neutral, and they need to get above neutral. So the data this week, it helps and push things in the right direction from a Fed perspective, but they still have a lot of work to do.
Isn't your call the firm's call that we're going to be in recession this year?
Yeah, I'm actually puzzled, to tell you the truth, why more people aren't forecasting recession. If you look at the consensus, people are expecting modest growth of 1% or so in the next 4 quarters, and we're looking for minus 1% or so in the next 4 quarters. The point I've been making is that we can't cure inflation in a painless manner. Some of this inflation will come down naturally as commodity prices stabilize and as supply chains improve. So that part of the inflation problem is fixable without a recession. The part that isn't fixable is the absolutely crazy red-hot labor market. The Fed has to see a major weakening of the labor market. Otherwise, we're going to get massive ongoing cost pressures with rising wages. There's no way the Fed can hit their 2% target for inflation in the next few years if they don't significantly cool off the labor market.
So most people think, well, if we're going into recession, why do they need to keep hiking?
Well, I think that it hasn't happened yet. I mean, the data are weak. They're very uneven, right? I mean, you're looking to the data this week was kind of uniformly weak. Remember, the housing sector is kind of the point of the spear on monetary policy. When you hike rates, that's the sector that gets hit hardest and fastest. And so there we're seeing the effects of the Fed already. What we're not seeing yet is significant weakening of the jobs market. Now, as you pointed out, claims are inching up, but by historic standards, they're way below normal still. They should be up well into the 300s. For the Fed to argue that they've gotten the labor market under control. So they need to kind of finish the job and keep hiking. If they were to back off now, I think you would see, the markets are pricing in those hikes. They're already embedded in the markets. It would be a remarkably surprising easing of financial conditions that's not at all warranted given the inflation outlook.
So in other words, you're saying in order to beat inflation kind of for good here, we have to be in recession, and that the concern is that maybe things don't slow enough. Is that right? Because, again, as the data keep evolving with every additional data point, you get this kind of sardonic reaction of this is the Fed's fault. They're causing this. This is now we're going to go from inflation to recession, just from bad to worse and so forth. Obviously, they'd like to achieve a soft landing and slow things down without a recession. It sounds like you're just saying that's unrealistic. And to make matters worse, that if they backed off, inflation could stay high even after we have a downturn. And we saw that happen in the 70s.
Right. And I think you do want to go back to history. I mean, the mistake the Fed made is not what they're doing now. It's what they didn't do a year ago. They waited too long to start hiking interest rates, and now they're playing catch up. The inflation readings we've gotten this year have been even worse than we expected. They were already starting to happen last summer and fall. The Fed described it repeatedly as transitory when it became clear that most of it's transitory, but a big chunk is not. And so they're fixing a mistake. And unfortunately, they have to risk a recession. There's no other way to get the genie back in the bottle. And I would go back to the 70s and give the following analogy. What's going on with the Fed right now is not Paul Volcker killing inflation. Paul Volcker stepped in after years of inadequate Fed efforts to control inflation. What we're seeing right now is the Fed at the beginning of the 1970s, when they had a chance to nip it in the bud and tighten and kill a modest inflation problem and keep that 2% kind of level for inflation. So the mistake is to not fight the inflation early and wait until it's really out of control. So we are in 1969. We're not in 1979. We need a tough Fed, but not a 1982 style collapse in the economy. We need a modest recession to get inflation under control.
Shepard Smith here. Thanks for watching CNBC on YouTube.